Welcome to Quick Financial Concepts, where we help you avoid costly financial mistakes by asking smarter questions. In this weekly series, we focus on 5 important questions you should ask before making major financial decisions. Today's topic: 5 questions to ask before paying off your mortgage early. Becoming mortgage-free sounds amazing, but before you send that big check to the bank, let's slow down and ask the right questions. Question 1. What is my current mortgage interest rate? This is critical. If your mortgage rate is 2.5 to 3.5%, many locked in 2020 to 2022, you may be borrowing extremely cheaply. Ask, could I earn more investing that money elsewhere? Am I giving up higher potential returns? Paying off a 3% mortgage gives you a guaranteed 3% return. That's safe. But is it optimal? Question 2. Do I have high-interest debt elsewhere? Before paying off a low-rate mortgage, ask, do I carry credit card balances? Do I have personal loans at 8 to 15%? Do I have auto loans at higher rates? If so, paying off high-interest debt first usually makes more financial sense. The math matters. Question 3. Do I have a fully funded emergency reserve? Once you send money to your mortgage, it's no longer liquid. You can't easily access it without refinancing or a HELOC. Ask, do I have 3 to 6 months of expenses saved? Would paying this off reduce my financial flexibility? Liquidity matters more than many people realize. Question 4. What opportunity cost am I accepting? Opportunity cost is what you give up. Ask, could this money be invested? Could it be used to grow income? Could it fund retirement accounts with tax advantages? Example, if markets average 6 to 8% long-term and your mortgage is 3%, you're trading potential growth for guaranteed savings. That may still be worth it, but it should be intentional. Question 5. What is the emotional value of being debt-free? This one matters. Some people sleep better without debt, value peace of mind over math, want guaranteed simplicity in retirement. Ask, am I optimizing for wealth growth or emotional freedom? There is no wrong answer, but clarity matters. Today's final thoughts. Paying off your mortgage early makes sense when you're close to retirement. You value stability over growth. You've maxed out tax-advantaged investing. You have strong liquidity. It may not make sense when your rate is extremely low. You have higher interest debt. You lack emergency savings. You're sacrificing long-term investment growth. Be intentional, not emotional. Now here's my personal story. I paid off my mortgage more than a decade ago. My interest rate at the time was 6%, and I was putting all of my bonuses and extra cash into the market and CDs. I weighed the decision, and it made sense to pay off the mortgage after a strong market run and the returns from cash accumulation. The peace of mind and reinvesting the savings into the market have paid off tenfold. Now, if this episode helped you think differently about paying off your mortgage, subscribe and tap the bell. Smart money decisions aren't always about doing what feels right. They're about asking the right questions first. And remember, smart money starts with smart questions.